in both personal income and spending in December. We also had consumer sentiment soaring in early January to its highest in about 3 years.
Don't forget about the Fed Beige Book. It found resilient consumer spending that helped propel the U.S. economy in recent weeks, offsetting weakness in other sectors like manufacturing. All sounds good.
Yeah, it does sound good.
Everything's great. Everything is awesome.
Not so fast, because credit card delinquency rates, sorry to be the bummer here, credit card delinquency rates have exceeded pre-pandemic levels, while the share of borrowers making only the minimum payment climbed above 10% for the first time since 2019. This is according to a Federal Reserve Bank of Philadelphia report, Tim, that was out earlier this month. So that's the bummer part.
Okay, well, let's get into it with our next guest, who's also tracking the credit health of the U.S. consumer. With us is the CEO of VantageScore, Silvio Tavares. Silvio, good to have you with us this afternoon. Here from San Francisco, we should note that VantageScore is a joint venture of Experian, Equifax, and TransUnion. It provides credit data, credit risk modeling, and analytics based out on the West Coast. So you got a recent report out, a December report. Talk to us about specific data points in the report that has you concerned.
Well, yeah, I think the main key point to start off with is that actually the overall consumer is healthy. You know, we measure the consumer credit health by the average Vantage score. A low Vantage score is 300, a perfect Vantage score is 850, and prime, which is the level where consumers usually get the best rate, is Vantage score 660. As you look through the end of December, we published this data today through our monthly CreditGauge, the average consumer credit score was 701. So that's actually a pretty healthy score. But what that masks is an area of concern, because basically the consumer is experiencing a bit of a credit hangover.
So average is mean.
Yes, and the average and the mean are the same for credit scores typically, because you see that nice normal distribution.
Average and the median.
Right.
Yes,
okay.
yes, correct.
So go ahead. You were saying, though, it masks some of the underlying maybe concerns there.
Exactly right. Because what we saw in December, which is the data that we published today, was that all of a sudden you're starting to see some signs for concern in terms of the increase in credit card. Credit card balances in December were up over 8.2% on a year-over-year basis. That's a big jump. And as we look also at delinquencies, the rate at which people are paying their loans late, we're actually seeing that increase on a year-over-year basis. It's a little bit of an increase, but when you see that trend, that's always cause for concern. And so the consumer is experiencing a little bit of a credit hangover. They spent a lot in December, and we're going to watch that going through the balance of the year.
Does the credit hangover portend anything more concerning for you than people just owing more on their credit cards? I mean, what are the knock-on effects of this? What has you concerned?
Well, the key concern is if this continues, you're going to see a rising level of defaults and delinquencies. And it's not all consumers are experiencing the same thing. So, for example, for the higher end, higher average age consumer, you're not seeing those delinquencies. But as you look to the lower credit tiers, Vantage score subprime and near prime, there's where you're seeing a higher rate of concern. Now, as you look at banks, you know, I'm using the analogy credit hangover. Well, the banks are still serving drinks. We actually saw credit originations increase in the month of December compared to November, and also increase on a year-over-year basis. So banks, we expected were going to tighten. That didn't happen in December. We're actually seeing banks continue to lend really across most categories. And so we're going to watch that trend, because obviously if you have higher delinquencies coupled with increased lending, that's not a good picture for banks.
We have a chart to share with everybody, and it does show what you guys have seen in terms of credit card balances over the last 4 years. So you can just see from November 22, from December 2022 to November 2023, December 2023, you can see the uptick and the build, right? That gradual build in terms of credit card balances. Having said that, Silvio, give us an idea of, you guys are getting data, right, from all the credit reporting agencies?
Yes.
I mean, so is it a nice cross-section, if you will, in terms of the U.S. population?
Yes, very much so. We have the most authoritative source on that data, because VantageScore actually scores approximately 30 million more consumers than the conventional credit scores. We're used by 8 of the top 10 banks and over 3,000 banks and fintechs. We grew at 30% last year, and approximately 19 billion Vantage scores were used. So it's the most authoritative source. And that's the challenge with a lot of the economic data that you're seeing from other sources right now. It's backward looking. It's like driving in the rearview mirror.
Right. Right.
We have the most recent data. And what it shows is overall the consumer's healthy, but we're starting to see some signs for concern. That delinquency rate increasing is one of them. The spike in credit card balances is another.
I mean, all this has me thinking about the power that the U.S. consumer has when it comes to the economy. I mean, this is an economy that the consumer certainly powers. Are there any macroeconomic takeaways that you can give us about credit score and what it means for consumer spending?
Yeah, well, the credit score, the VantageScore, is the real authoritative source of credit health. And what we're seeing is it's becoming very much of a tale of two cities. Those older, more affluent consumers, Generation Xers, they're actually doing pretty well. So, for example, in December, we saw Generation Xers increasing their credit card balances. But those folks, you don't have to worry about them. They typically have higher average credit scores and higher wealth. What's more concerning is that younger and mid-tier consumer, and when you look forward, they're going to be facing some economic headwinds. The most significant one is student loans. We're seeing those student loans payments kick in.
Is one reason that their credit score isn't as high or their Vantage score isn't as high is because potentially they don't own a house, they don't own an apartment, they don't have that credit history that younger generations or older generations had when they were their age?
100%. And what we see is that home ownership is a huge driver of wealth. The average home equity in a home today is $248,000. So if you have a home, you're doing pretty good. If you don't, you have more challenge. And that younger consumer doesn't have as much as an economic cushion to weather the storm against rising inflation and that higher average credit card statement that they have. They also don't have much of a cushion to pay for that unexpected loan repayment. And that's why it's so important. Recently, we saw some of the regulators actually mandate the use of VantageScore for mortgage. And so we're going to be seeing a lot more of those younger consumers, those underserved consumers getting a chance at their first home. And we expect that to really help with credit health.
I feel like these are a lot of the topics we've talked about in the last year or so. Is there anything, just 30 seconds left here, Silvio, that was surprising to you that you think our investing audience should know about? It might be whether it's cause of concern or cause of calm, if you will, just quickly.
Well, I think the most surprising thing, the most newsworthy thing is the reality that banks aren't tightening the way that we expected. We expected to see into December a cooling economy and banks really pulling back on their loans. We didn't see that. In fact, we saw the opposite. And so that's a key theme we're going to be watching throughout the year. Of course, the whole reason why the Fed increased rates is that they expected banks to tighten somewhat. And actually, we're seeing banks in a very principled way looking to maximize that net interest margin on new loans they're making. So we'll have to continue to monitor that.
All right, we've got to leave it there. Silvio Tavares, CEO at VantageScore, joining us here in studio. This is Bloomberg.